The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. I'm Michelle Hebert, Director of Communications here at Saney's, and I want to welcome you to our second webinar in our Financial Friday series. Saney's is excited to offer these sessions in cooperation with our corporate partner, AXA. AXA has a long-standing presence in New York, and a large portion of AXA's New York client base is built upon the work they do with the public education system. Through AXA, Saney's members can receive competitive insurance rates and a full array of retirement services and financial planning, including a complimentary financial profile for Saney's members, which is a great benefit that we urge you to take advantage of. Our AXA presenter today is Craig Danieluk. Craig has been with AXA out of the Rochester office for about 8 years. For the last 3 years, he has been in the vice president role, managing a team of advisors whose primary focus is on assisting school employees and their families. Craig is married to a teacher, so he certainly understands the unique circumstances that school employees face when planning for families in retirement. So before we get started, just please note that all participants are muted during the session. However, if you have a question for Craig, you'll see that there's a chat box down below in your panel. And so you could raise your digital hand or type a question there. And if it's pressing, we can get to it right away. Also, there'll be some Q&A at the end, so we'll save time for that. So with that, I'll turn the presentation over to Craig. Craig, can you hear me?
I can, Michelle. Thank you for the introduction. So first, I wanted to, thank everybody for jumping onto this webinar today, just to gather a little bit more information about how to protect your family, your future. And I know that everyone on the call will be at different stages, whether they are, in their early 30s, or maybe they're somebody who is now really considering retirement, or maybe you're on the threshold of retirement. So at the very least, I hope that you can pull maybe one or two things out of the webinar itself. And then obviously everybody is always welcome to reach out to me offline, and I'm happy to answer any more specific or personal questions that come along. So first and foremost, it's just important for me to let everybody know that I do not give any tax or legal advice. I'm not an attorney or a CPA. So if those questions do come up, I'm certainly willing to guide, but I'm always going to defer to the folks that are the experts in those particular situations. So the three things that we want to talk about today are the different phases that an individual goes through in their career. The first is, the juggling act of balancing what you are trying to do today with your obligations to your family and loved ones, as well as looking at what your career goals and your financial goals are going to be down the road. After that, the second step we're going to look at is when you do have a family, what are the ongoing financial issues that are going to continue to come into play that you should be considering both now and during that time period. And then the third phase that we look at is your long-term future. What does it look like to start planning for retirement as you're going through phases 1 and 2, as well as what does it look like when your family is maybe out of the house and now it's just you and the spouse, or maybe yourself at home, who's really starting to think about what the next steps are going to be. So jumping right into it, we'll talk about phase 1, the balancing act. And one of the big things that AXA will always talk about, and you'll notice from the previous slide, it says it takes baby steps. One of the most important things to consider when you're going through a financial picture for yourself is that it doesn't need to be a situation where you look at it and you say, oh man, that's so far off, I can never get there, or that takes too much money, I'll never be able to afford it. The important thing is to take small, manageable steps. We always refer to it as an actual child who, it's amazing for those of you that have children, you look at a baby when it takes its first few steps, and then a week goes by and all of a sudden those steps are all the way into the kitchen, and next thing you know, their hand is on top of the countertop and you have a new set of problems on your hands. But the small manageable steps are what gets you to the end goal without you really feeling too much of the pain and realizing it. What you need to do is simply create a map for your future. It doesn't need to be incredibly detailed at this point, but you want to have a road plan for where you're going to get to. I know Michelle mentioned it earlier. AXA provides a a financial plan to every member of Sainies at no financial cost to themselves. So it doesn't matter where you are in your life. It's always a good idea to reach out to us so that we can provide that map for you, so that it gives you some sort of plan to go after. It keeps you focused. You know, it helps you coordinate what your goals and your obligations are, not only today, but we look at what they're going to be in the future. You know, another big key factor to it is that it provides calm to the chaos. And what we mean by that is oftentimes there's things that are going to come up in life that seem rather chaotic. But if you know where the end goal is, if you know sometimes when you're sailing across the ocean, you're going to hit rough waters, but you're eventually going to make it to the other side, it helps put some calm. You know those rough times are going to come, but you're also able to continue sailing along. So the first step is protecting your loved ones. This is something that is very, very close and passionate to my heart. To give you guys a brief story, I had a client who I started working with when he was 27 years old. Unfortunately, due to circumstances, he passed away incredibly young at age 31 from cancer. And there's two things that I always remind myself about his story. And the first one is, you unfortunately never know how young you are going to be when you go. And this individual, thankfully, you know, took the steps to get life insurance to protect his family before he even found out he had cancer. And the second thing that always sticks out in my head, because this in particular person became a very close friend over time, and I'll never forget the day his wife said to me, "Craig, this is terrible to go through emotionally. I can't imagine what it would be like if I had to worry about the financial part." And it's something that has always stuck in my head for two reasons. One, I was, you know, at the calling hours when she said this to me. And two, my wife was with me and said the exact same words when we were in the car. The impact that it can have is incredible. So life insurance is something that everyone really should give a strong consideration to, because you're making an income that if suddenly that income was to go away, your loved ones are going to have to figure out a way of replacing that income and doing it incredibly quickly. You know, it goes beyond just replacing the income. How would a surviving spouse, if he or she went back to work, well, now they need to pick up the cost of potential daycare or other bills. And maybe that spouse, you know, wasn't used to paying the mortgage that came out of your salary, and now they need to worry about that. So life insurance is something that everyone should be considering. I also will caution everybody. A lot of folks say, well, you know, hey, I have 3 times my salary that gets provided to me as part of the benefit that I have. The 3 times your salary is a tremendous benefit, but in most circumstances, only 50,000 of that is tax-free income that will pass on to the surviving spouse or the beneficiary of your plan. The remainder, so if we make the assumption you make $100,000 a year, $300,000, 250, because 50 we know is tax-free, the other 250, the individual that is your beneficiary would have options, but if they take that as cash, it's going to be a taxable cash event. $250,000 at one time as a cash event can lead to some pretty substantial tax implications that need to be planned for as well. So when you're looking at getting true life insurance from a life insurance carrier, it's important to remember that the funds that come out of that, under most circumstances, there are some caveats, but under most circumstances, they will provide a full tax-free benefit to your beneficiary. Some other ways of protecting your loved ones besides the life insurance is to look at disability and long-term care insurance. Don't assume that the district has you covered for both disability and long-term care. With disability insurance, sometimes I'm working with a school district that needs to wait over a year before they can collect disability. Well, do you have 12 months of your salary saved so that you can provide that income during that time period? Long-term care is becoming more and more important. Some of you may be responsible for caring for an elder parent at this point, and you can see the cost, and maybe you have even looked into long-term care facilities for an elder parent, and you know how expensive those can be. So those insurances are also important to think about. Property and casualty liability protection. Now, while that's not something that AXA in particular helps you out with, I do always recommend that someone sit down with their insurance broker that does their property and casualty and looks at that. Are they properly covered? Is their home covered? If they own a camp or a vacation property, are those properly covered if something was to happen? Maybe an umbrella coverage needs to be added on top of it. Health insurance. Now, we all know that school districts typically will give a very handsome health insurance plan to the individuals, but you want to make sure that what coverage you are picking is best for you and for your family. If you are on a high deductible plan, are you taking advantage of an HSA? Or if you are on an HMO plan, are you considering what could happen if you had to get some unwarranted tests that may bring on a new financial burden? So you always want to make sure that you are looking to make that you have the correct insurance protection in case the unexpected comes into play. So the first step, I talked about it a little bit before with the life insurance. It's your ability to generate income. That's the foundation for your family to be able to live the lifestyle that they're currently living. We always talk about you insure your car, you insure your house, but did you insure yourself and your ability to continue to work for years to come and provide that stability for your family? That goes along with disability insurance. So 25% of today's 20-year-olds will become disabled before they retire, which to me is an incredible stat, that 1 out of every 4. So if I can look at the number of attendees on this list and I'll round up to 16, if we were all 20-year-olds, 4 of us would become disabled before we retired. Now, when I sit down with folks and I talk about disability insurance, I always relate it back to the car and to houses. You have insurance for your car in case you get into an accident. You have insurance for your home in case something happens, someone trips and falls, or maybe unfortunately it catches on fire. I always say, well, what if you had a machine in your basement, and that machine, legally of course, just printed money over and over and over again? And there was a company out there that says, hey, listen, if something happens to your money printing machine and it breaks down, we'll give you some insurance. We'll give you money while that thing's getting fixed. Then I always pose the question, what do you think that machine is? And the answer is that machine is you. You are the individual that is going to work, making the salary, making the paycheck, and you are the one that is printing that money for your family over and over again. If something was to happen to you, wouldn't you want insurance to pay or give you some sort of income while you were trying to recover, whether it was from a fall or a surgery, and continue to receive money to continue your family, to continue the lifestyle you're used to until you're able to return back to work? Some other things that I strongly encourage everybody to look into is a will. Wills don't necessarily have to be incredibly expensive documents that cost thousands of dollars. Oftentimes, for a few $100s, you and a spouse or yourself can get a will that takes care of what happens to your property and what happens to you when you pass. I have seen this before, so I always encourage folks to do it. It names heirs that will get your property when you pass. Most importantly, in my opinion, if you have children, you can designate guardians of minor children. Now, I know that this is often difficult to do in deciding who is going to, raise your children if you're no longer around. But I can tell you from experience on 2 different cases with clients that I have, they did not name who was going to get the minor children, and it just can become a major legal battle because in both situations, both sets of grandparents want it to take the children. Obviously, both sets of grandparents have the best interest of the grandchildren in mind, but they both want the custody. Now, by designating guardians, I'm not saying that you're not going to hurt feelings when you pass, but at least the children are not the ones that are stuck in the middle of a legal dispute between grandparents. And while you may hurt feelings, I like to at least think that one set of grandparents is going to at least say, well, you know what, my son, my daughter, my daughter-in-law, whomever designated it, and there's nothing I can do to fight. I just need to figure out how to work with the other grandparents so that I can see my children as often as possible. Establish trust to protect property. Wills help you reduce fees, expenses, allows you to reduce estate taxes if you have an estate tax issue. And it also allows you to designate any money that you have that you may want to leave on to charity beyond your passing. So moving on to phase 2, raising a family and the ongoing financial issues, cash management really begins with your assessment of income, expenses, and your opportunity to save. It can't be a situation where you are winging it, to use a lack of a better term. When we do a financial plan for the folks through Saney's, we really do drill down and we want to see, what are you spending your money on? Are you going to Starbucks? Are you going to Dunkin' Donuts? Do you stop at the grocery store and pick up a prepared meal every night? Or how often are you going out to eat? That's how the level of detail that we're going to get, because that's going to help us discover your opportunity to save. It's also going to help you discover where your expenses are and where most of your income is going. So we'll talk a little bit about the kiss of debt and then more about rainy days. So the kiss of debt is what we refer to as credit cards. For someone who has a balance of $3,000 at 12% interest, if you pay $50 a month, it'll take you 7.7 years to pay it off, and you pay over $1,500 of interest. So a $3,000 balance, if you just multiply it by 50%, that is about the interest you're going to pay in order to pay it off over time. Now, to put that into a little bit of perspective, $3,000 is far below the average credit card balance of the average American. So, if you multiply this up, most of them are carrying anywhere between $10,000 and $15,000 at this point. You can really see how this really starts to come into play. So what do we do in order to get rid of the kiss of debt? First, stop using the credit card whenever possible. But the secret to getting things taken care of is to select the credit card with the highest annual rate first. Regardless of balance, select the highest annual rate first. And you need to commit to paying more than the minimum. What I always suggest, let's say you have 4 credit cards. One has a 10, 11, a 12, and a 13% interest rate on it. We know that the 13% is the highest. Pay the minimum on the 10, 11, and 12, and pay the most that you possibly can on that 13. And once that 13 is paid down, if you were paying $200 a month on the 13 and $50 a month on the credit card that only had a 12% balance, take the $200 from the one you were paying that you've now paid off and add that to the $50 you were paying on the second highest interest rate. And then start plugging away at taking care of that. Other considerations to make: you can transfer balances to a lower cost credit card. There are many credit cards out there that will give you 0 APR for X amount of months. They usually will charge you roughly a 3% transfer fee, but frankly, oftentimes mathematically we can figure this out, but 3% is better than the 12% you were paying. Consider a home equity loan. A home equity loan would be at a lower interest rate. You'd be able to pay off all your credit card debt, and then you just pay the home equity. And then finally, be realistic with a budget and stick to it. If you know that you're using your credit card to live above your means, you need to be realistic about that budget and continue to move forward. Rainy days, this is a question that I get asked, I'm going to guess 5 times a week. And the magic number is there is no magic number. But for rainy days, you always need to plan for things that may pop up in life. And we all know they're going to be there. And it can be anything from the car breaks down to we need a new roof to, you have 2 or 3 children and you need to pay for gymnastics, soccer, basketball camp, and then T-ball is coming up as well, and that's going to cost you $1,000. So you need to prepare for all of those in life. Most people will tell you that you need to have 6 to 8 months of emergency funds to be comfortable for a rainy day. Now, while I would be thrilled to see most of the folks that I work with have 6 to 8 months, I will tell you that on a personal level, I am okay when I see a school employee have anywhere from 4 to 6 months. And the reason why I'm okay with that is because the stability, typically speaking, of a teacher or an administrator or someone who works in the bus garage that has been there for 10 to 20 years, there really isn't the same type of insecurity in terms of whether your job will be there the following year. So I'm not as concerned for folks that don't have 6 to 8 months, but I would like to see them be at the very least just below those 6 to 8 months if they work in the education system. College funding, interestingly enough, if you look at over the past 10 years, college has increased at about 3.5% per year beyond inflation. However, if you look at just the last 6 years, instead of being a 3.5%, you're looking at about a 9% in the public sector, 11% in a 2-year college, and 13% at private nonprofit institutions after adjusting for inflation. So over the last 10 years, we have seen a pretty significant increase, but if you more focus in on the last 5 to 6 years, that is really where things are really starting to ramp up. Scholarships and grants, there's about $46 billion in grants and scholarship and money awarded every year, plus $3.3 billion in aid that is awarded from private sources. I will also tell you that AXA gives out money every year in a scholarship. The more folks that apply for the scholarship in a specific area, the more scholarships that AXA will give out in that area. So if you have children that are of college age that are going into their freshman year, I strongly encourage you to have them apply. And then the final way to fund college is obviously through loans. And 70% of students graduate with loans, myself being one of those. College savings tips. First, savings accounts. Consider tax advantage accounts and higher interest bearing. Scholarships. Scholarships are a nice bonus, but I caution everybody to count on a scholarship coming into play, especially when I work with folks that talk about athletic scholarships. Just to give you a statistic that I got from JP Morgan, athletic scholarships are obviously rare. Less than 2% of high school athletes go on to play a Division I sport. And obviously we know that even if you go on to play a Division I sport, you're not necessarily going to get a college scholarship. I always refer it back to, my undergraduate is from St. Bonaventure, and one of my roommates was on the cross country team, which was a Division I sport, and he did not have a scholarship. He ran purely because he enjoyed cross country. So just because you're an individual that may be playing a Division I sport does not necessarily mean that you're even going to get a scholarship at that point. And we know that Division I athletes only represent about 2% of the population of high school. Beyond that, there's grants. If you make more than $50,000, you're very likely going to miss out on the ability to get the federal Pell Grant. And then loans are the last place we want to go after all of our other sources have been exhausted. Different types of accounts we can use for education. There's the UGMA and UTMA account that allows you to control securities that a minor would actually be the one who owns. A covered out savings accounts, they're formerly known as education IRAs. And those first two accounts have really given way to the more popular 529 counts, which is the state operated investment plan. If you do have a New York State 529 plan and you contribute to it, you do get a deduction on the contribution that you put in. The other thing that I will tell you is there is a Group 529 plan that we are starting to implement in several of the Rochester area school districts. The nice thing about the group plan is if your school is on board and we set it up, you can contribute to this account directly from your payroll, and the sales charge that you would normally have to pay gets waived by JP Morgan. So if anyone wants to talk more about that for their district, I'm more than happy to chat with them about that as well. And finally, because we have about 5 more minutes, the final phase, your long-term future, your retirement. Key things, look at your long-term financial independence, establish goals now. If you don't establish the goals now, you're going to have nothing to work for and no end sight to go after. And develop a program and look to meet it. Getting started is tough, which is why we tell everybody to make small, manageable steps. It's not a situation where you need to start saving $2,000 a month now. Maybe that you can only afford to put away $200 a paycheck or $400 a month. That's fine. It's our job as advisors to continue to work with you and to continue to get you to increase over time. And before you know it, that 200 turns into 700, and here we are well on our way to getting to that $2,000 a month number. It's never too late to start, but the earlier you start, obviously the better. The compounding effect that your money has is incredible. There is a rule that we often refer to as the rule of 72. And really what that means is for an individual who is aggressive, it should take them aggressive in terms of their investments. It should take them roughly 7 years for their money to double. So if you're aggressive and you have $10,000 in the account, 7 years from now, that $10,000 investment should turn into roughly $20,000. Now, everybody's tolerance for risk is different. The lower of risk you're willing to take, or the more risk-averse person, obviously the potential reward is going to be a little bit lower, as you can see on this graph. So the rule of 72 applies. If you divide your expected rate of return by 72, that is about how many years it should take for your money to double. Like I said, somebody who is aggressive can look to get a double money in about 7 years. Managing risk, don't put all of your eggs into one basket. I never want to see anybody have all of their money into one particular fund. There's always a good idea to diversify into different asset classes. It helps take out the cliffs and valleys of the investment cycle and give you more of a rolling hill. So instead of being just in the S&P 500, which is large US companies, maybe we want to put you into some medium companies, some small international emerging countries. Maybe we also put you into some international developed countries like your Germanys, your Frances. So it's always a good idea to diversify out so that one particular economy or one particular sector of the economy doesn't have a massive impact on your overall growth potential on the account. Retirement plans, funding your 403B or your 401k for a spouse is obviously the best way to go when you're working through the districts. There are 2 different types of plans. Not every district offers them, but there is the 403B traditional option, and there's also the Roth, which allows you to save after-tax money. The 403B traditional would be taxed when you take money out in retirement. The 403B Roth would be taxed now and then tax-free upon distribution in retirement, as long as you hit certain criteria. Some of the things that are offered through your employer plan in the 403B, depending on what provider you're working with, there can be loan provisions that you can take out. There's higher contributions. Oftentimes you can do up to $24,000 a year, depending on your age. In regards to the age, there is no restriction on contribution. So if you're still working at a school and you're 73 years old, you can still contribute to the account, and you are not required to take money out of the account, which is often required of folks that are retired when they reach 70 and a half. And then the last thing is, it doesn't matter what your income level is, you still are allowed to add money to your 403B as long as you're still employed there. For those of you that are in districts that there is a match of any sort, I strongly encourage you to at least take advantage that match, whether you have to put in a certain amount of money to get there, or if they just put it in, make sure the account is open so that you can take advantage of it. Retirement on your own, there's the ability you can open up a traditional or Roth IRA. If you have a spouse that is not working, there's also spousal IRAs. So if you are in the fortunate situation where you're able to save even more money, then you would be able to put funds away in the name of your spouse in an IRA. If you have a side business, we can look to save even additional money into SEP or simple plans, or perhaps even a 401k, depending on what type of business it is. And then when they consider consolidating scattered IRAs, I usually tell folks that it's usually a good idea. Now, without seeing everyone's specific situation, you can't give that blanket statement, but when you consolidate IRAs, oftentimes, like everything else, you give yourself better access to what type of investment options that are available, because some funds have minimums, and when you consolidate, you might be able to hit the minimums. When you consolidate, you might also get enough funds within a certain mutual fund family where they'll lower the overall cost structure for you. So it is a case-by-case basis, but the most often time answer I receive when we talk about consolidating scattered IRAs is most people just want to do it simply because they want to have everything in one place. They don't want to be getting statements from 10 different companies with several different people managing the money. They want it in one place where they can take a look at it and know where they're going with it. So a few more slides. Annuities, they provide tax-deferred accumulation. You can put money into an annuity. You're not required to pay any tax on it until you start pulling the money out. Annuities now can also offer guaranteed retirement income. Some people like the idea of knowing that they can spend down their assets. They'll have Social Security, and they'll have an annuity that's paying them every year no matter what. Municipal bonds, they can be triple tax free. They can also be a little bit tricky, so make sure you're working with your advisor or doing a lot of research on them. But depending on the bond that you buy, the coupon payment that is going to pay out, or the interest that pays out, is going to be completely free of local, federal, and state taxes. Now, there's some residency restrictions that go along with it, so just make sure that it applies for you there. And then life insurance, we talked about it before, about how it's there to protect your family. It's also there to protect your pension. And then with permanent life insurance, it does also build up cash value inside, which can be pulled out of the life insurance account to use things to fund a wedding, a boat, retirement. Maybe you actually are retired now and you no longer want to pay for the life insurance. You can let the cash value pay the life insurance for you, so that when you pass away, it's still, the benefit is still given on to your loved one or your beneficiary. So with so many different things, where do you start? Like I said, to me, the first plan is to take advantage of the free plan that AXA gives you, just to assess your current picture. It'll give you an idea of whether or not you do have enough protection for your loved ones. It'll give you a snapshot as to whether or not you are spending too much, and whether or not you need to start reeling in some of the debt that you have out there. Pay yourself first, meaning save for retirement. You can take loans for most things in life, like college, but you can't take a loan from the bank to retire. Work with whatever planning professional, CPA, or attorney you're working and happy with. Continue to work with them and stay close to them. And perhaps the most important part is to make sure that on an ongoing basis, you're reviewing and fine-tuning your strategy. Your strategy today may involve 3 children, but 2 years from now, there could be another child on the way, or maybe that other child has, come along. So make sure that you're reviewing and fine-tuning your strategy as things continue to go on. So starting now, your role, just know your obligations and goals, know where you stand and when you want to achieve those goals, how you want to achieve those goals. And then the role that we have as the advisors is simply to help you develop that program to get you on the path and get you moving to achieving that financial success for your family. So Michelle, I know that I took up the full 35 of the 30 minutes I was allotted. But if there's anyone that has any questions, I'm happy to try and answer them now before they have to jump off the call.
Okay, there is one quick question. The question is there an advantage to just transferring ownership of the entire home and property to the adult child?
So that is again, the legal side of things, where I'll say that you want to talk to your attorney. However, there are advantages and there can be advantages. I'll give you a personal example where my parents have actually transferred ownership of their home to my brother and to my sister, myself. The reason that they did that is because both of my parents are over the age of 70, and they are concerned that if one of them was to pass and then the other had to go into a long-term care facility, that given the state, it depends where the parents live, et cetera, there's different laws that apply as to how long the ownership needs to be transferred. But let's just say 15 years from now, my folks have to go into some sort of assisted living facility. The asset of the home is no longer theirs. So it's not a situation where they would have to sell that home in order to pay for the assisted living facility. Now, on the other side of things, my in-laws just did this last year. They didn't want to have to go through the typical standard waiting period. So they put the home into a trust, which means they effectively immediately gave up ownership of that home. They cannot make any decisions for that home technically without speaking to my wife or to my brother-in-law, because they are the executors of that trust. So there are folks that would transfer it to an adult child simply because they're looking to get around the potential consequence of having to sell that home in the future to pay for some sort of cost of care.
All right.
Hope that answers the question.
Okay. Any follow-up question there? Okay. I guess that looks like all the questions. Now, to be sure, this session has been recorded and it will be emailed to all registrants as well as the presentation. And then we archive all of our Financial Friday webinars at saneys.org. So you can find them there. And if there are no further questions, I think we'll sign off. All right. Thank you, Craig, and Happy New Year to everyone. And hopefully we'll see you next month for our next Financial Friday, the basics of taxes. That should be fun, huh? On February 2nd. So you can sign up for that now at saneys.org. Thank you.
Thank you.